How are trusts taxed after the grantor dies? Have you ever wondered what happens to a trust when the person who created it passes away? Understanding the tax implications can be quite important for both trustees and beneficiaries. When a grantor of a trust dies, the tax status of that trust changes dramatically. During the grantor's life, a revocable trust is treated as a grantor trust for income tax purposes. This means the grantor reports all income and deductions on their personal tax return. But once the grantor dies, this status ends, and the trust becomes a separate taxable entity. First, the trust must obtain its own taxpayer identification number. This is essential if it does not already have one. The trust will then need to file its own income tax returns using Internal Revenue Service Form 1041. Now, the trust is responsible for reporting and paying taxes on any income it generates. Next, the classification of the trust for tax purposes is important. The trust can be classified as either a simple trust or a complex trust. A simple trust generally must distribute all income to beneficiaries each year. Those beneficiaries then report that income on their own tax returns. A complex trust, on the other hand, can accumulate income or distribute principal, and it pays taxes on any income that it does not distribute. It is also important to note that the estate of the deceased is a separate taxpayer. The estate must file its own income tax returns. There is often an option to elect a fiscal year instead of a calendar year. This can provide tax deferral benefits and give more time for estate administration. Now let's talk about basis step-up rules. When a person dies, their assets usually receive a step-up in income tax basis to fair market value. This can reduce capital gains tax if the assets are sold later. However, recent guidance from the Internal Revenue Service states that for assets held in a grantor trust, no basis step-up is allowed at the grantor's death if the trust is considered a grantor trust for income tax purposes, but the assets are not included in the estate for estate tax purposes. This can have significant tax consequences for beneficiaries when they sell trust assets. If the trust is irrevocable and continues after the grantor's death, the successor trustee takes over. This person is responsible for managing the assets, paying debts and taxes, and distributing assets according to the trust terms. Irrevocable trusts typically avoid probate, which allows for faster distribution to beneficiaries. The trust will file its own tax returns and pay taxes on any income it retains. Trustees should promptly obtain a taxpayer identification number for the trust. They should carefully review the trust terms to understand distribution requirements and file necessary tax returns. Beneficiaries need to be aware that any income distributions from the trust will be taxable to them. Additionally, any income retained by the trust will be taxed at trust tax rates, which often reach the highest tax brackets at lower income levels than individual taxpayers. In summary, after the grantor's death, trusts transition from being disregarded entities for income tax purposes to separate taxpayers. The trust must comply with income tax filing requirements, and the tax treatment will depend on the trust's terms and classification. Understanding these changes is essential for managing tax obligations effectively and planning distributions accordingly.